Hello ECO152 students, welcome to second section of week 10. During this session, we will cover the concept of inflation, which is a macroeconomic indicator for price stability. We will concentrate on section 10.1 and 10.2 only from our prescribed textbook, Understanding Macroeconomics, second edition. At the end of this session, you should be able to do the following. Firstly, define inflation. Secondly, explain how inflation is measured. Thirdly, calculate the inflation rate. Fourthly, distinguish between consumer price index and the producer price index. And lastly, explain concepts such as hyperinflation, deflation, stagflation, and disinflation. Inflation is defined as a continuous and considerable rise in prices in general. From this definition, there are four important aspects that we need to note. Firstly, the definition is neutral, meaning there is no distinction between goods and services or an attempt to define it based on specific causes. Secondly, it is a process, meaning it happens continuously over time and not just a once-off rise in prices. Thirdly, the rise in price should be a considerable increase, implying that it should be measurable between two periods or over time, and the difference should be of a considerable magnitude. Lastly, the rise in price must be of the general prices, meaning that if prices of a specific good, e.g. timber chips or meat, increases, that will not be considered inflation. Therefore, inflation is only when all or most prices of goods and services increase over time. The measurement of inflation requires a yardstick or instrument that considers changes in the general price level. The most commonly used indicators are the Consumer Price Index and the Producer Price Index. The Consumer Price Index is a number or an index that reflects the cost of a representative basket of consumer goods and services. In simple words, it shows the cost of a shopping basket that includes goods and services for a typical South African household. Thus, it is an indicator of the cost of living. Recall from chapter 5, section 5.4 that when constructing the CPI index, the Statistics South Africa officials considers the following element: the basket, the weights, the base year, the formula, and the price collections. The unadjusted CPI is known as headline CPI. The Producer Price Index is a number or an index that reflects the cost of goods at their first significant commercial transaction, that is, at the factory. Therefore, it reflects changes in the prices of manufactured goods in terms of the cost of production. Thus, it is an indicator of the cost of production. Both the CPI and the PPI indices are used as deflators, that is, values used for transforming nominal values into real values in the calculation of the national accounts. The two figures shows the Statistics South Africa Consumer Price Index and the Producer Price Index. The Consumer Price Index is reflected from January 2016 to December 2020, with the base year being December 2016. Recall that in the base year, the index will be equal to 100. The Producer Price Index is indicated for the 5 different categories of PPI for July 2018, June 2019, and July 2019. The base year for the PPI index is also December 2016. Once Statistics South Africa had compared these indices, then we can use these indices to calculate the inflation rate. The inflation rate is calculated as the percentage change in the CPI index from one period to the next. It is always expressed as an annual rate and mathematically illustrated by the following formula. The inflation rate is equal to the CPI in the current period minus the CPI in the previous period divided by the CPI in the previous period multiplied by 100. There are two methods used in the calculation of the inflation rate. These are the month-on-month and the annual average on annual average. In terms of the month-on-month calculation, the CPI index of a particular month is compared to the CPI index of the same month in the previous year. It covers a period of 12 months. This is the most used approach, and you will use this approach for the calculation of the inflation rate in this course. Let us use the CPI table in the previous slide to calculate the December 2020 inflation rate using the month-on-month approach. So the first thing we do is we reflect our formula. The inflation rate for December 2020 is equal to the CPI for December 2020 minus the CPI for December 2019 divided by the CPI for December 2019 multiplied by 100. If we substitute values, we would have 117.3 minus 113.8 divided by 113.8 multiplied by 100. If we substitute that, we would have 3.5 divided by 113.8 multiplied by 100. That should give us a value equal to 3.1%. This result indicates that prices increased at a rate of 3.1% between December 2019 and December 2020. In terms of the annual average on annual average, the CPI indices of all monthly indices in a particular year is compared to the annual average of the previous year. This approach covers 24 months. Let us again use the CPI table in the previous slide to calculate the December 2020 inflation rate using the annual average on annual average. So the first thing we do is we show our formula. The inflation rate for December 2020 is equal to the CPI, which is the average for 2020, minus the CPI, which is the average for 2019, divided by the CPI, which is an average for the year 2019, multiplied by 100. If we substitute values, we would have 115.9 minus 112.2 divided by 112.2 multiplied by 100, and that should give us 3.7 divided by 112.2 multiplied by 100. If we solve that further, we should have 3.3%, which just simply indicates that on average prices increase at a rate of 3.3% between 2019 and 2020. The annual average on annual average method offers a better indication of the inflation rate over a longer period as it eliminates short-term fluctuations in prices. Please note that the calculation of the PPI inflation rate is exactly the same as the one we have just done now with the CPI inflation rate. There are important differences between the consumer price index and the producer price index. These are, firstly, the producer price index, which shows prices at the factory gate, indicate the cost of production, whereas the consumer price index, which shows prices at the store, indicates the cost of living. Secondly, the producer price index basket consists of goods, only goods, whereas the consumer price index basket consists of goods and services. Thirdly, the producer price index includes capital and intermediate goods, whereas capital and intermediate goods are excluded in the CPI. Lastly, the PPI prices exclude value-added tax or VAT, whilst the CPI prices include value-added tax. Let us now look at concepts that are related to inflation. Hyperinflation refers to very high and persistent inflation. See box 10.2 for a discussion of hyperinflation. On the other hand, deflation refers to negative inflation or continuously falling general prices of goods and services. See box 10.1 for a discussion of deflation. Also, we have stagflation, which refers to high inflation accompanied by high unemployment and low economic growth. Lastly, we have disinflation, which refers to positive inflation but at a decreasing rate.